Interest rates are coming up. The Federal Reserve is changing those things. Who is the Fed, and how does that affect you? I'm going to answer that question today.
Selling your home isn't as hard as it may seem. Would you call Brian Crawford at the New Mexico Dream House team?
All right, so the Fed. What is the Fed? Well, the Fed is short for the Federal Reserve. The Federal Reserve is made up of three primary components: the Board of Governors, the Federal Reserve Banks, and the Federal Open Market Committee. So the Federal Reserve has five primary functions. Number one, to conduct the nation's monetary policy. Number two, to promote stability of the financial system. Number three is to promote the soundness of financial institutions, your banks, all of those things, mortgage companies. Number four is facilitating US dollar transactions, both internally and internationally. And then finally, promoting consumer protection. So in summary, their goal is to protect the US economy and to protect US citizens. That likely means you. The Board of Governors is actually appointed by the President of the United States. It consists of 12 members, and all of those members are confirmed by Congress. The Board of Governors oversees the Federal Reserve banks and promotes financial regulation, meaning they make all the rules and all the guidelines for the FDIC, who insures your money once it's in the bank. But basically their goal is to protect you through regulations from corporations and predatory practices. So that's what the Board of Governors does, and oversees the 12 Federal Reserve banks. Now, what are the 12 Federal Reserve banks? The 12 Federal Reserve banks are actually divided up demographically throughout the US, and they have equal populations that they represent. So the goal of having 12 is to protect the geographic and demographic interests of the people who are in those particular areas. So you have, in New Mexico, you have a bank that actually represents you, and that's grouped in with other areas in our region as well. It's kind of interesting, they're broken up into geographic regions as indicated by this map right here. So these 12 banks will actually gather information and bring that back and create financial policy based upon the information of the citizens that are gathered in that district. Their goal is also to comply with regulations and federal guidelines. So the Federal Open Market Committee is the committee that actually oversees things like interest rates of hard goods. Those are houses, cars, industrial averages. So the Federal Open Market Committee is also known as the FOMC. So it kind of breezed over the Board of Governors, and also kind of breezed over the Federal Reserve banks, because in reality, in our industry, the Federal Open Market Committee holds the most weight. So they'll determine things like base interest rate. That's the interest rate that the Federal Reserve Bank as a whole will set as a standard for what they're going to lend money at. So cars, houses, manufacturing, boats, hard goods that tend to last a long time. These are your non-usury rates. These are things that last a long time, that are typically financed year over year as opposed to month to month. These rates are set by the Federal Open Market Committee more specifically. So what does this mean? When they raise interest rates, they're effectively trying to slow inflation. Or if they drop interest rates, you probably saw the news about 2 years ago when we entered into COVID-19, they were trying to boost the economy. So they actually dropped the federal interest rate down to zero. Now, you weren't paying 0% interest on your house because there are overlays and there are certain targets you have to hit so that banks can make their profit, individual banks can. But the Federal Reserve was lending money at 0%. The Federal Reserve has actually committed to slowing down the rate of house prices. So what they're doing right now is they're actually raising interest rates. And we've seen this because we're hovering right around 4.5% right now compared to 3% a year ago, and interest rates on mortgages actually dropped into the 2s. So the Federal Open Market Committee actually indicates what those interest rates should be, and they try to kind of guide and bring stability into a market. The reason why they're increasing interest rates is they keep hearing the stories, just like we are, of houses hitting the market, buyers fighting over them and not being able to attain them. So they're actually trying to slow the housing market down. What does this mean for you as a seller? When they're trying to slow the market down, there will be less buyers. We have seen people with a $200,000 pre-approval 2 months ago now at $170,000 pre-approval because it really affects the monthly payment. That's what the Federal Reserve is. It's the Board of Governors, it's the Federal Reserve Banks, and the Federal Open Market Committee. The one that is most going to affect our transactions is the Federal Open Market Committee. We're affected by everything they do. The Board of Governors is obviously protecting consumers by banning usury rates and that sort of thing. So this will slow the rate of housing growth over the next year. And it's a fine line. The FOMC is really trying to suppress inflation while not causing another recession. So this affects you. It directly correlates to what your house payment will be with your latest mortgage. Thanks for watching. I hope that was helpful. That's the Federal Reserve in summary.